Well, all this week here on The Open on BNN Bloomberg, we are exploring the road ahead. We got through that first half. We'll see what happens over these next 6 months. We're exploring a number of themes. Hard to ignore the world of commodities and specifically energy and oil prices. What does the rest of the year hold? Well, let's get some perspective on someone who has covered this market for many years. Francisco Blanch is Managing Director and Head of Global Commodities at Bank of America Global Research. His phone has been very busy throughout this year. And now that we have Francisco, a growing debate, it seems, on Wall Street on the outlook for oil, just in part because of this recessionary risk. What's top of mind for you? What's your general perspective on what's happening in the oil market?
Sure. So let me start off by saying that I think we are living through a major global energy crisis at the moment. But the global energy crisis really didn't start in oil. It started in gas and power, started in Asia, and now has hit Europe full on. And oil is not in a crisis mode yet. So I think oil still has pretty strong fundamentals looking at transportation fuels. And the weaker portion of the oil market has been, in the last couple of months, really been the naphthas and the other petrochemical inputs like ethane and propane. So you're starting to see the weakness showing up in the industrial oil uses, but you're still getting pretty strong consumption on transportation and services. And then
if we were to see that full-on recession that everybody's talking about. I mean, you talked about some of the industrial uses. I guess a lot of people are also trying to figure out, well, everyone's already frustrated with gas prices. If people are feeling more stretched, consumers, Canada, the U.S., around the world, are they going to drive less? Is that going to weigh against oil? What would you say to that?
Well, I would say for sure they're going to drive less, right? I mean, higher prices, by definition, do slow down demand. But I think what's important to acknowledge here is that we live in a world where both the sensitivity of demand to price has fallen, but also sensitivity of supply to price has fallen. So as a result, we're getting more violent price movements. Again, it's not true just true for oil. It's true for thermal coal, which is trading almost at coal parity levels, at oil parity levels, right? Thermal coal has been trading close to $100 a barrel of oil equivalent. So you look at Brent. You look at WTI, you look at Canadian oil. And again, when you realize how expensive thermal coal prices are, which again is literally dirt coming out of the ground into a barge, right? And it really puts into perspective where we are in the cycle. So I am definitely concerned about a slowdown in the second half of the year. I think if we get to a recession, oil will probably end up averaging $75 a barrel next year. I'm talking about Brent. Mostly because we do have severe supply constraints building up. And then I think in the case that Europe decides to go on with some of the Russia oil sanctions that have been debated for the last 2 or 3 months, you could see prices potentially shooting up to $150 a barrel. And this is, I think, the environment we live in today. It's a very uncertain environment where there's a huge tug of war going on between supply and demand. And at the moment, there's a bit of a race to the bottom. We are slowing down demand because we don't have the supply. And prices and higher interest rates are actually the mechanism to slow that demand down.
Yeah, everybody watching those central bankers working fast on that, unfortunately, demand cool down. So you talked in terms of Brent, and hopefully we can get the video there back from Francisco. But just for our audience, in terms of WTI terms, can you walk us through that range that you could see based on the tug of war unfolding right now?
Sure. So as I said, I think if you have Russian supplies staying, remember, we just keep ignoring the big elephant in the room. I mean, Russia is the world's second largest crude oil exporter, is the second largest petroleum product exporter. So far, we haven't had a shortfall in crude oil. And part of it is that we are releasing over 1 million barrels a day of oil from the Strategic Petroleum Reserve in America. And other parts of the world have also joined in the effort. So we don't have a crude shortfall because we're releasing government stocks. But coming to the winter, there's a risk that European that European electricity markets essentially go into a proper full-blown crisis mode, where we have rolling brownouts, where we have severe demand rationing. That's not an environment where oil prices are going to come down. So that's the scenario where, as I said, if Russian supplies drop from about 10 million barrels a day today, about 10% of the world's supply, which is about 100 million, drop down to like, say, 8.5 million barrels a day. So we see an additional 10, 15% drop in Russian supplies. We could see $150 a barrel for oil into the end of the year. And we don't know what Putin is going to do at this stage, but certainly he's using energy quite effectively to really hamper European industry in many ways. And I think if we end up seeing a situation where supplies just flow more freely, there's a recession, we'll see weaker oil, but it's not going to be a crash like we had back in 08. It's not going to be a crash like we had back in 15, 16, or even in the second quarter of 20, where we had negative oil prices. It's going to be a modest pullback, in my view, because inventories are very, very low.